Hello everyone, welcome to Intermediate Accounting 2, Chapter 20. In this video, we're going to go through Part 1, which is going through the leasee, and the next video will go through Part 2, which is going through the lessor. So just to explain that a little bit, there is two parties to every lease agreement. There's the lessor, which is the party that owns the asset and is leasing it out. And then there's the leasee, which is the party that rents out the asset or leases the asset. So in this video, we're going to talk about the leasee. We're going to go through, I'll show you just the topics we're going to go through. We're going to go through how do you determine what type of lease it is for the leasee under ASPE. Then we're going to go through the journal entries for the different types of leases for under ASPE. And then we're going to go through the journal entries for the leasee under IFRS. So we're just going to do the three top topics in this video. The next video is going to go through the lessor, the three types of leases for the lessor, the journal entries for the lessor, and then we're going to go through something called sale and leaseback for both the lessor and the leasee. So this video is just going through the leasee, the person that is renting or leasing the asset. So leasee means the renter or the leasee. Or the person that's leasing the asset. Lessor is the owner of the asset. I guess to make it a little bit more, to remember this a little bit more, the lessor, there's an O in the lessor, there's no O in leasee. The O in lessor means owner. So that's how you can remember the two different terminologies here. So lessor is the O is the owner of the asset. The leasee is the one that's renting out the asset. Okay, let's get started. So when we're talking about leases, if you're gonna use an asset, there are two things that you can do. You can lease the asset or you can buy the asset. And there's different reasons why companies will lease an asset versus buying an asset. So if you're only going to lease something or only need something for a short period of time, maybe you'll just lease it. Maybe it's cheaper to lease than to buy. Maybe you want to test out some sort of asset, like maybe you don't want to buy it right off the bat because you just want to test it out for a few years first, or you're waiting for the newer model to come out because you want to buy that one, so you want to lease the older model for a couple years. Many different reasons why a company will lease instead of buying an asset. The two parties, the leasing and the lessor, are going to get together and create a lease agreement. So the lease agreement should state who the two parties are. It should state the lease term, so the length of the lease. So is the lease a 5-year, 10-year, 15-year? It's also going to discuss any renewal periods. So if a lease is 5 years, but you can renew it for another couple years, that will also be under the lease terms. It's also going to discuss the amount and timings of the payments. So how much it has to be paid. And is it monthly lease payments? Is it annual lease payments? Is it semi-annual? Or bi-weekly, weekly? So what are the timings of the payments and what the payment amount is? And then also it's going to talk about the responsibility to pay any maintenance, insurance, property tax. So if you lease out a building, is the leasee required to pay the property tax, or is the lessor required to pay the property tax? What about the assurance? What about maintenance? If you're renting a car, usually what happens is the leasee, the person renting, is responsible for the maintenance, not the lessor. But if you're renting a building or you're renting like an office space or something, usually the lessor is responsible for the property tax. Okay, but the responsibility of who has to pay what should show up on the lease agreement. And all these terms are important for us to go through when we're figuring out what type of lease do we record, how do we record it. So under ASPE, there's two types of leases. So when a company is leasing an asset, it's either going to be an operating lease or a capital lease. So an operating lease means that all the risks and awards of ownership are not transferred to the leasee. A capital lease means the risks and awards of ownership are transferred to the leasee. So what a capital lease means is that it's basically, it seems like you own the asset without actually owning it. An operating lease doesn't look like you own the asset. The risk and awards of ownership are not transferred to the leasee. So let's start with talking about what an the operating lease. So the operating lease is the default lease. What we're going to go through under ASPE, there's 3 criteria that you have to go through to determine if something is a capital lease. If none of those 3 criteria are met, then the lease under ASPE is automatically an operating lease. Okay, so what we're going to do, I'll show you the 3 criteria in a second, but basically if none of the criteria are met, then we have an operating lease. And an operating lease, the journal entries for that are pretty straightforward. So if there's an operating lease, what we're going to do is we're going to just debit rent expense or lease expense, so rent or lease expense. Okay, so that gets debited, and we're going to credit the cash. So if we have to make payments of $1,000 a month, every month we'll do this journal entry, debit your lease expense, credit your cash. Okay, so pretty straightforward. Whatever cash you pay is going to be what your lease expense is. So this is similar, if you remember from chapter 19 videos, this is similar to like a defined contribution where you just have an expense. We had pension expense and cash. So here we have lease expense and cash. Okay, so for an operating lease, if it doesn't meet the criteria to be a capital lease, then, and it's an operating lease, anytime you have a lease payment, debit the rent expense, lease expense, credit cash. Okay, so very straightforward for operating leases. When we go through capital leases, we have, like I said, we have 3 criteria to go through to determine if something is a capital lease. And if only 1 criteria needs to be met, okay, so just the 1, so only 1 criteria needs to be met in order for something to be a capital lease. If none of the criteria, so 0 criteria are met, then it's an operating lease. If 3 criteria are met, like, you know, at least 1, so I should write at least. If at least 1 criteria is met, then it's a capital lease. If all 3 criteria or 2 criteria are met, then it's still a capital lease. If none of the criteria are met, it is an operating lease. Okay. All right, so let's go through each of the criteria. The first criteria, and in these criteria, so there's going to be 3 criteria I'm going to show you. These criteria are going to help us determine if all the risks and awards of ownership have transferred to the lessee. So these are questions that we have to ask in order to determine, are all the risks and awards transferred? Okay, so the first one is there reasonable assurance that the lessee will obtain ownership of the leased property, including through a bargain purchase option? So first one, is there going to be, who's going to own the asset at the end of the lease term, basically? Is it going back to the lessor, or is it going to be transferred to the lessee? And this bargain purchase option, and let me just explain it in a little bit further. So what a bargain purchase is basically what it's trying to say. Like, you get a bargain for, you get something that's lower than its fair value. Okay, so this bargain purchase option is going to be lower than the fair value of the asset. And that's how you know that it's a bargain. So at the end of, so let's say it's a 5-year term. So if it's a 5-year lease, and this happens a lot with cars. So if you lease a car and it's a 5-year lease, at the end of the 5 years, you have an option to purchase the car. So let's say you have an option to buy the car for, let's say, $10,000. Okay, so after the 5-year lease, you have an option to buy the car for $10,000. It's only going to be a bargain purchase option if this $10,000 is less than fair value. So if the fair value of the asset is, let's say, $14,000, okay, so if you want to buy that car out in the market, it would be $14,000, but because you lease this, you have this option to buy it for $10,000. So in that case, this is a bargain purchase because you're getting it for $10,000 when everybody else pays $14,000. Even if the company doesn't know for sure when they first lease the asset whether they're going to take on this bargain purchase option, you should ask yourself, like, why wouldn't they take on this bargain purchase option? If they can get this for $10,000, even if they don't want the car, they can get it for $10,000 and then sell it for $14,000 and make a $4,000 profit. Okay, so that's what a bargain purchase is. It means that the option to purchase under the lease is going to be, the amount is going to be lower than the fair value of the asset. Right. Just get rid of that annotation. Okay. The second criteria for lease capitalization is that the leasee will benefit from most of the asset's benefits due to the length of the lease term. So in this case, what we have to do is we have to look at what the lease term is. We have to compare the lease term to the economic life. Okay, so versus the economic life of the asset. So it's saying, is the lease going to use up most of the economic life of the asset? So will the leasee benefit from most of the asset's benefits? Then I'll explain this in a little bit more detail in the next slide. And then the third criteria is the lessor recovers substantially all its investment and earns a return on its investment of the lease property. So where the present value is substantially all of the fair value of the asset. So now we're looking at the lessor side. So does the lessor recover all of its investment and earns a return on the investment during the lease term? So during the lease term, is there enough lease payments, enough of a lease term in order for the lessor to recover their money? Okay. To do this, we're going to compare the present value of the lease payments, of the minimum lease payments, and I'll show you how to do the present value calculation in a bit. So present value of lease payments versus the fair value of the lease asset. Here it says substantially all. So does it cover substantially all? In the second criteria, it says most. Okay, so what does most mean? What does substantially all mean? So they don't quantify an amount of how much of the PV should be the fair value of the asset. So that's not really quantified for us. So we have to quantify that. There are guidelines that companies use to quantify these amounts. And for this one, for number 2, it is 75%. So in this case, most means 75%. So does the lease term cover 75% of the economic life? And when you're looking at substantially all means 90%. So is the minimum lease payment, present value of the minimum lease payments, at least 90% of the fair value of the asset? Okay, so we do have guidelines on what is substantially all and what is most. Okay, so the 3 tests, so looking at those criteria, so that those criteria are from the handbook. We have 3 tests to go through. So first test, so 3 criteria, which means 3 tests. So the first one is a transfer of ownership test. Is there an automatic transfer? So we talked about a bargain purchase option, but there could also be an automatic transfer. So the asset could automatically transfer, right? So if, for example, the asset would go to the leasee at the end of the lease term. And the reason why this might be in the contract is if the leasee is going to be using the asset for majority of its economic life, then that asset may not have any use for the lessor again. So if it's all used up and nobody else can really use it because it's really old now, will the lessor want it back, or would they just let the leasee take the asset at the end of the lease term, because they would have recovered all their investment anyways? Yeah, so it could be an automatic transfer, or there could be a bargain purchase option. If there's any of those, then this test has been met. For the economic life test, the lease term needs to be greater or equal to 75% of the economic life. Okay, so you're going to take the lease term, divide it by the economic life, see if that's 75%. If so, this test is met. And then the investment recovery test, we're going to do a present value calculation. So hopefully you remember how to do those. So the present value of the minimum lease payments has to be greater or equal to 90% of the fair value of the asset. So we're going to do a calculation on the present value. And then we're going to compare it to the fair value of the asset. And if the PV is 90%, at least 90% of the fair value, then this investment recovery test, it has been met. Like I said, only one criteria needs to be met, or one test needs to be met in order for this to be a capital lease. Okay. So go through the 3 tests. So what I want you to do is go through each of these 3 tests. So even if there is a transfer of ownership and you know that, oh, if this criteria has been met, then that means I know it's a capital lease, so I don't have to move on. What I want you to do for this course is to make sure you go through all 3 tests, explain whether they're met or not met. Maybe this is met, and then do your conclusions. So then you would say, you know, in conclusion, this is a capital lease because, you know, 2 criteria are met, or 2 tests are met. Okay, so you need to go through all of them, even if the first one is met and you know it's a capital lease, go through each one first. All right, so to calculate the minimum lease payments, so for criteria number 3, you need to compare the present value of the minimum lease payments to the fair value. So in order to do that, we have to do our present value calculation, and then I'll explain what inputs go into the present value calculation. Okay, so there's something called a guaranteed and an unguaranteed residual value, which may affect your present value calculation. So like for your present value calculation, how many inputs you have. So you have your PV, which you don't know what that is. That's what you're calculating. You have your FB, okay? You have your I, which is your interest. You have your N, which is your number of periods. And then you have your mode. Your mode is either going to be your beginning mode or it's going to be end mode. So the mode, whether it's beginning mode or end mode, this, oh, I'm missing one. I'm missing the PMT, the actual payment. Right? Okay, so beginning mode or end mode, if the lease payments are going to happen at the beginning of the period or the beginning of the year, you're going to use beginning mode. If they happen at the end of the period, you're going to use ending mode. Okay, so that one's pretty straightforward. Your number of periods is your lease term. Okay, so you know, if you're leasing it for 5 years, then it's 5. I guess this would be like the number of payments. So number of lease payments is a better way to describe it. Okay, so it's the number of lease payments. So if there's 2 payments a year, then it's going to, and it's 5 years, then it's going to be 10 is your N. Okay, so the number of lease payments. Your fair value, so your fair value is where this whole guaranteed unguaranteed business comes in. So your residual value generally is how much the asset's going to be worth at the end of its life. Sometimes the leasee will guarantee that value. So the leasee will say, you know, if the guaranteed residual value is $5,000 at the end of the lease, let's say if it's $5,000 guaranteed residual value, then the leasee guarantees that the lessor can sell this asset for $5,000 at the end of the lease term. If the lessor cannot sell this asset for $5,000, then the leasee has to make up the difference. Okay, so because they've guaranteed it. So guaranteed residual value means that the leasee is saying, I will guarantee you will get $5,000 from this asset if you sell it once I'm done with it. If you don't, then I'll pay you the $5,000. If they don't get anything, then they'll pay the $5,000. If they only get $3,000, then the leasee will pay the other $2,000. Okay, so it's a guaranteed residual value. The leasee is guaranteeing that the lessor will get that money, either through him or through the company or through selling the asset. An unguaranteed residual value is the same concept, except it's not guaranteed. So the leasee does not have to pay it. Okay, so it's basically, it's a residual value. They, you know, the lessor expects to get $5,000 out of the asset when they sell it after the leasee uses it. But if they don't get that money, the leasee doesn't have to pay any money. Okay, so it's unguaranteed. So the only thing that would go into the future value is going to be a guaranteed residual value. And unguaranteed means the leasee doesn't have to pay anything, so we don't have to record that. So the future value would be a guaranteed residual value, if there is one in the question. Okay. So either the asset's going to go back to the lessor and the leasee is going to guarantee how much they can sell it for or unguarantee it, or there could be a bargain purchase option, which I talked about earlier, where a bargain purchase option means that the leasee is going to buy the asset for amount significantly lower than fair value. So either they're going to give it back and guarantee the future value, or guarantee the residual value, or they're going to have a bargain purchase option and they're going to purchase it. So one or the other is going to be your future value. Okay. All right. So future value is either going to be your guaranteed residual value or a bargain purchase option. You wouldn't have both scenarios in here because either you're giving it back and guaranteeing a value that the lessor can get from it, or the leasee is buying it. So one or the other. Executory costs. We talked about how we have to figure out who's responsible for the maintenance, the insurance, the property tax. So if there are any extra costs that the leasee is responsible for, those get subtracted when you're figuring out what the lease payments are. So the PMT is going to be your minimum lease payment. So it's going to be whatever the total lease payment is for each period, less any executory costs that the leasee has to pay. So if the leasee has to pay any maintenance, if they have to pay any insurance, right? So executory costs is whatever the leasee pays. So if it says that the leasee has to pay these amounts, when we're doing our PMT, we're going to take our lease payment minus any of the executory costs. Okay, so your lease payment less any of those costs. So I don't think I should say total lease payment, because I don't want you to total up everything you have to pay, just the like monthly lease payment or the annual lease payment. All right, next one is your discount rate. So your I. Okay, so when you're trying to figure out what to put for your I, it's going to be the lower of either the implicit interest rate of the lessor or the incremental borrowing rate of the leasee. Right? So there's two rates here. The lessor has a rate of how much, like, the rate of return is going to be, and the leasee has a borrowing rate of how much they borrow for. ASPE says we're going to use the lower of these two rates. Okay, so lower of either the implicit interest rate or the incremental borrowing rate of the leasee. So you're doing lesser of. I don't have a room for this, but the lesser. So the lesser amount of both of those. Or the lower amount of both of those. Okay, so either you're using the lower of either the incremental borrowing rate of the leasee or the implicit rate of the lessor. So those are the components that go into the present value calculation. So you can input them in your calculator or in Excel, and then you get your PV at the end. And then compare this PV with the fair value of the asset. If the PV is at least 90% of the fair value of the asset, then you have a capital lease. Then that third criteria has been met. All right, so let's try a question where we can practice the present value calculation and also practice how you get to either is it a capital lease or an operating lease. So if you go into the Excel chapter 20 part 1 at class exercises and go to question 1, we have a question here talking about a lease between Herbert and Russell Corporation. Okay, so we have all the information here and the inception date. There's annual lease payments due at the beginning of each year. The annual lease payment is $20,066. We have a guaranteed residual value in this case of $2,000. Lease term is 5 years. Economic life is 10. Fair value is 88,000. Lessor's borrowing rate, lessee's borrowing rate, 9 and 10%. Okay. So what I want you to do, we're just going to do part A for now, is discuss the nature of the lease for the lessee, and they follow ASPE. Okay? And it says the asset reverts back to the lessor at the end of the lease term. The lessee is responsible for all exploratory costs, which means if the lessee is responsible for all the exploratory costs, which that means there's no exploratory costs included in this lease payment. So if it said that this $20,000 includes $3,000 for maintenance, we'd have to take the $3,000 out when determining the present value. Okay, so in this case, there's no exploratory costs included in our lease payment. Okay, so what I want you to do now is pause the video and go through this question. So go through the 3 lease criteria for ASPE, and then determine whether it's a capital lease or an operating lease. And to do the 3rd criteria, you need to do the present value. So do the present value of the minimum lease payments. Okay, so pause it and try it now, and then you can unpause when to watch the take up. Okay, so I'm going to take this up now. So we'll go through each of the tests, right? Each of the criteria. Okay, so first one, is there a transfer of ownership test? Okay, so is the lessee going to own the asset at the end of the lease term? Well, because there's a guaranteed residual value, that usually means that it's going to go back to the lessor, and it just tells us right here. It says the asset reverts back to the lessor at the end of the lease term. So no, there is not a transfer of ownership because we don't have a bargain purchase or automatic transfer. And I just copied what it says up here just to explain my reasoning. The lease reverts back to the lessor at the end of the lease term. Okay, so just explaining yourself here that of why you're saying no, there isn't, or not met. There is no transfer of ownership test. Or sorry, there is no transfer of ownership. Okay, the second question or second test is the economic life test. Here in the economic life test, we need to compare the lease term with the economic life of the asset. The lease term has to be a certain percentage of the economic life, and it's 75%. So lease term has to be at least 75% of the economic life. So if we do our calculation here, 5 years of the lease term divided by 10 years economic life is $50,000, and that is less than 75%. So no, this test has not been met, right? So it's only 50% coverage, and it has to be at least 75%. The last question the last test is the investment recovery test. So here we need to determine, is the present value of the lease payments at least 90% of the fair value of the asset? Okay, so fair value is 88,000. To do this question, we first have to calculate the present value. So I can do this up here. So we can do this with Excel. So we have a PV equals. Okay, so if you want to learn how to do it on Excel, we need to have our rate first, which is our I. So we have 2 rates here. We have the lessor's implicit borrowing rate and the lessee's borrowing rate. ASPE says we use the lower of the 2 rates, so we're going to use the 9%. Okay. Number of periods, we have 5 years. Each lease payment is annual, right? So 5 payments. Our PMT is what our payment is every year, so 20,066. Again, it does not include any other costs, so we don't have to subtract those out. And our future value, we have a guaranteed residual value. That will be our future value of $2,000. And then the type or the mode, it's asking, is it end mode or end type or beginning mode? So do these payments happen at the beginning of the period or end of the period? So it tells us here that it's the beginning of each year. So we're going to do 1, which is beginning mode. All right, so if we do all that, we get, oh, it's a negative because I've made my payments a positive. But if I make my payments a negative, it doesn't matter. So this is just the way that I have this calculation set up. So you either make both positive or both negative. There we go. So 86,375 is our present value. We need to compare this to our fair value. So let me go down to here. So we have our present value. I showed you the inputs of the percentages. So if you are going to do this, I want you to input what you've done for your calculation. So on an exam or anything, then I know what you did. So even if you get your present value calculation wrong, at least I can see what you did here. So the 86,375, which is your present value, divided by the 88,000, which is the fair value, that equals 98%. And that is more than 90%, right? So therefore, yes, the investment recovery test has been met. So we had a no, no, and a yes. Only one criteria needs to be met in order for this to be a capital lease. So then you would show your conclusion and say, therefore, this is a capital lease as criteria 3 has been met. Okay, so go through each of these tests, explain why the test has been met or not met, and then do your conclusion on whether this is a capital lease or an operating lease. If this resulted in an operating lease, so if none of these criteria were met and this was an operating lease, then the journal entry would be straightforward. You would just every year, January 1st, take this 20,066, debit lease expense, credit cash. Okay, so you wouldn't have to worry about doing anything else if this was an operating lease. But because it is a capital lease, we have more complex things that we have to do, which we'll just talk about next. So here, let's go to the next part, which is the journal entries for capital lease. Okay, so when you're recording the capital lease, first thing you do is record, you're going to have an asset and liability. So if you remember the definition of a capital lease is all risks and rewards of ownership have transferred to the lessee. So it's basically like owning an asset, but not actually owning it. So because it's like owning an asset, we're going to actually record an asset on our books, and then we're going to record a liability on our books for all the lease payments we have to make. The asset and liability amount is going to be the lower of either your present value of the minimum lease payments, so which we would have calculated already when we were doing criteria number 3. So lower of that, or the fair value of the leased asset. Okay, so the asset can't be lower than the fair value. So your asset liability is either the lower of present value of the minimum lease payments or the fair value of the asset. The debits and credits, so we're going to debit equipment under lease, so we're going to credit obligation under lease. Okay. So that's your first journal entry at the start of the lease. Then the second journal entry, anytime you have a lease payment, so anytime you have to make the lease payment, and in our example we were looking at, it was every January 1st for 5 years, we're going to debit obligations under lease and credit cash for the lease payment amount. Okay, so we're bringing down our liability every year until we get it all the way down to its future value. Okay, then at year end, we have 2 entries we have to deal with at year end. The first one is we're going to do a depreciation entry. So if we're recording a capital asset, you obviously have to depreciate your capital asset. So we're going to debit depreciation expense and credit your accumulated depreciation. And I'll explain how you calculate that in a second. And then another entry we have to do at year end is the interest expense entry. So your liability is going to be the present value of your minimum lease payments. Anytime you have a present value calculation, at the end of the year, you always have to update your present value because a year has gone by. So we need to update our liability balance because the present value that was January 1st is no longer the same present value, right? Present value is going to change every year. So in order to update our present value, we have to debit our interest expense and credit our liabilities or obligations under lease. So I'll explain how to calculate both of those. So to calculate your depreciation, there's a couple options that you have to calculate your depreciation. if the asset goes back to the lessor at the end of the lease term, okay, so if the asset reverts back to the lessor, so the leasee doesn't keep the asset, it goes back to the lessor, and you have an unguaranteed residual value, you're going to take the full amount you've capitalized and divide it over the lease term. If there is a guaranteed residual value, you're going to take the full capitalized amount less your guaranteed residual value divided by the lease term. Okay? So if the asset's going back to the lessor, you're only going to divide it, the depreciation period is the lease term. If the asset's going to, if the lessee is going to obtain ownership of the asset at the end of the lease term, then we are going to take the fully capitalized amount less any residual value, doesn't matter if it's guaranteed or unguaranteed, and divide it by the useful life of the asset. Okay, so basically, your depreciation period is how long you're gonna have the asset for. Are you gonna have it for the whole time? Because the lessee is gonna take the asset at the end of the lease term, then you divide it by the useful life. Okay? If not, then you divide it by the lease term. All right, so that's the chart on how to figure out depreciation. And then to figure out your interest expense, we would do in amortization table. So you've most definitely seen an amortization table in your other courses. So you're just doing a similar amortization table than what you're used to. We're going to have our annual lease payment, and that's without any exploratory costs. We're going to have our interest. Your interest is going to be your discount rate. So whatever rate you used, or like whatever your I was in your present value calculation. And you're going to multiply that by whatever your balance is in your lease liability, right, every year. So you're going to have a different amount because your balance is going to change. Your lease payment, like let's say, like your A minus B is going to equal your C. So you're going to take your lease payment minus your interest. That's going to give you this. And then the balance of the lease liability is whatever your opening is, right? So your opening balance minus whatever your C is. Okay, so minus C. Right? So the date, the lease payment, your interest, which is your discount rate multiplied by the balance. Subtract the 2, that's going to be your reduction, and then balance is whatever your opening balance is minus your column C. Right? Okay, so let's try that. Let's go back to question 1, and then we'll try the amortization table and do the journal entries. Right, so let's go back to question 1. So let's try B and C. So B says, prepare a lease amortization schedule for Russell, who is the lessee. And then part C, prepare the journal entries on the lessee's books for 2017 and 2018. Okay, so it starts 2017. So again, pause this video, go through those B and C, try to do an amortization table, try to do the journal entries, and then you can unpause the video and see if you did it right. Okay, so let's take that up. So amortization table. I've done what the amortization should have. So date, annual lease payment, interest, reduction of lease liability, balance of obligation. Okay. On January 1st, 2017, you start off with your balance of your liability. So this you can get from your present value, right? So your present value is going to be what your liability balance is going to be at the beginning of the lease. So this 86,375. So we have our 86,375. Okay. Also on January 1st, what's going to happen is you're going to have a lease payment, right? The first lease payment is January 1st, 2017 of 20,066. Right? And every year you're actually going to have 20,066, right? So every year you're going to have a lease payment. Your interest on the first day, there is no interest accumulated because your 86,375 is your present value, right? So there's no interest on the first day of the lease. So if you take column A minus column B, you get column C, which 20,000 minus 0 is 20,000, and then reduce your balance. So if you take your 86,000 minus your 20,000, you're going to get 66,308. All right. So your whatever your opening amount is minus the reduction gives you your balance at the end of the year. Then January 1st, 2018, a year has gone by, you're doing another lease payment. In this case, you're going to have your interest. So your interest is going to be your I, which in this case was 9%, right? The lower of the lessor's rate and lessee's rate. And you're going to multiply it with whatever the balance of your lease obligation is. So in this case, our balance coming into 2018 is 66,308. Take 20,000 minus 5,900 gives us 14,000. Take 66,000 minus 14,000 gives us 52. Okay, so hopefully you get the hang of this, and you just keep going down and doing the same thing. 20,000, this 4,600 is your 9% times 52,000. 20,000 minus 4,600 gives us 15,000. 52,000 minus 15,000 gives us 36. Okay, so go through all that, and you'll notice at the end of the lease term, so the lease is for 5 years, so it's going to end at the end of 2021. You are going to have your balance of your obligation is going to be whatever your future value is. So the $2,000, which is our $2,000 here. Okay, so that's our future value. Oops. Okay, so that should be what's left over in your amortization table once you've done doing all the entries. All right, so that's your amortization table. Part C goes through the lessee's journal entries. So first journal entry, you just can follow what I had on the PowerPoint slides. First journal entry is your leased asset or equipment under lease. We're going to debit our present value of the minimum lease payments. We're going to credit lease obligation or obligation under lease, 86,000. What else happens January 1st, 2017 is there is a payment. So we're going to debit our lease obligation, 20,066, credit our cash, 20,066. So those are the two entries at the beginning. At the end of the year, we have two journal entries. One is for our interest expense. So we're going to debit interest expense, credit our lease obligation. And if you go over to your amortization table, your first interest amount is 5967. So we're going to record that, 5967. Okay. Last one is your depreciation entry in 2017, at the end of 2017. So here, to do the depreciation entry, we have to figure out, is the asset going back to the lessee or staying with the going to the lessor or staying with the lessee. Okay, so you start off with your asset of 86,000. The asset is going back to the lessor at the end of the lease term. So let's go back to our chart. Okay, so it is going back to the lessor at the end of the lease term. So, and we do have a guaranteed residual value. So in this case, this is our situation. So we're going to take the capitalized amount minus any guaranteed residual value divided by the lease term. Okay, so you take your 86,375 minus our guaranteed residual value we had of 2,000, right? And we're going to divide it by the lease term, which is 5 years. So if you do all that, you're going to get 16,875. And it's straight line, so every year it's going to be the same amount. Every year you're depreciating 16,875 until your leased asset goes down to zero. Or sorry, down to $2,000. The next part was asking what are the journal entries for 2018. So only 3 journal entries for 2018 because in 2017 the first journal entry was setting up the leased asset. We don't have to do that going forward, we just do it once. So we just have our cash payment, again same amount, 20,066. Debit our lease obligation. We're going to have our interest expense, which is going to be a different amount because we're going to look at our amortization table for that. So if you just look at the second number on our amortization table, 46.98. Okay, so that goes down, and we do our interest calculation. And then our depreciation straight line, so it's the same amount as we calculated here in 2017. So once you get the hang of the first year's journal entries, the next few years are going to be just the journal entries, one for the cash payment, the interest, and then the depreciation. All right. Okay, so that was ASPE for the leasee. So let's go to IFRS now and figure out the criteria for lease for IFRS. When looking at IFRS 16, companies must first assess whether each contract they enter into actually contains a lease. So you just have to step back and make sure that it is a lease contract or it contains a lease. So that means it conveys the right to control the use of the asset for a period of time in exchange for money, so consideration. IFRS is different from ASPE in that all leases are going to be recording an asset and a liability, and there's only two options or two opportunities where it is not recorded as an asset and liability, where it would just be recorded as just an operating lease. So the only two times it could be recorded as an operating type lease is that it's a short-term lease, so 12 months or less, or it's a low value lease, so the asset being worth less than $5,000. In those two instances, then you can do, so either or. So in either or of those instances, if it's a short-term lease or a low value lease, then you can just record the lease payments as a debit to lease expense, a credit to cash. But if it is a longer term lease, so more than 12 months, or the asset is worth more than $5,000, then we have to record what's called a right to use asset and a liability. So the right to use asset and lease liability is recorded at the present value of the minimum lease payments. So similar way as ASPE, except the one difference between ASPE and IFRS in calculating the present value of the minimum lease payments is that IFRS uses the lessor's implicit interest rate to do the present value calculation, whereas we know ASPE uses the lower of either the lessor rate or the lessee rate. Okay, but ASPE uses the lessor's rate. So just have to make that note of the difference between the present value calculation. And then the journal entries for the inception of the lease, similar to ASPE, but we're just it's called something different. So it's going to be called right to use asset instead of asset under lease or equipment under lease. We call it right to use asset, and we're going to credit lease liability. And then all the other journal entries are similar. So whenever you have a cash payment, we'll debit the lease liability, credit cash. At the end of the year, you can have a depreciation entry and an interest expense entry, and those are all calculated the same way as ASPE. So the only difference in the numbers is going to be that present value calculation may be different because you're using lessor's implicit interest rate. All right, so let's try to do another question, which is a lease question under IFRS. Okay, so if you go into question number 2, we have kind of a similar arrangement here. We have the lease payment starting July 1st, in this case, $19,000 lease payment. There's a bargain purchase option instead of a guaranteed residual value of $3,000. Lease term 5, economic life 10, fair value 90, and we have the lessor's rate and the lessee's rate. Okay. Both Herbert and Russell follow IFRS 16. So discuss the nature of the lease to the lessee. Amortization table, prepare the journal entries for the lessee for 2014. This should say 2017 and 2018. Okay. Assuming that Russell's accounting period ends December 31st. Okay, so when we did question 1, the fiscal year end was January. It was a calendar year, right? January 1st to December 31st. So the lease term started on the year start. In this case, our counting period ends December 31st, but the lease is entered into on July 1st. Okay, so when you're thinking about what's your year-end journal entries, we're only going from July to December in this case, instead of January to December in the last question. So you have to keep that in mind when you're doing your interest expense entry at the end of the year. We wouldn't do it for the full year, for the full amount. And for the depreciation entry, you're not going to do depreciation for the full year in the first year. Okay. All right, so pause this video, try this question using IFRS, and then you can unpause and see if you did it correctly. All right, so let's take this up. So first, discuss the nature of the lease to the leasee. So because they're following IFRS, there's just those two little criteria you have to go through, whether it's a short-term lease or a low-value lease. Otherwise, all other leases are going to be recording an asset and a liability. Okay, so is this a short-term lease? So no, it's not a short-term lease because the lease term is 5 years. If the lease term is less than a year, less than 12 months, then it would be short-term. So we'd say no, it's longer than 12 months, it's 5 years. Is this a low-value lease? No, because the fair value of the asset is more than 5,000, it's 90,000, right? So it's higher than 5,000, it's 90,000. Therefore, this is a right to use asset and a lease liability we have to record, okay? Part B says this prepared amortization schedule. So similar to the one that we did in the last question. To do the amortization schedule, you first have to figure out the present value of the lease payments, because that's going to be the balance of your lease liability day one. So your PMT, 19,000. We don't have any exploratory costs that are included in this, so we're going to use 19,000 as our PMT. Our future value is your $3,000 bargain purchase option. Lease term is 5 years. And then when talking about which one do we use, lessor's rate or the lessee's rate, under IFRS, we're going to use the lessor's rate. We always use the lessor's rate for IFRS. So if we input all of those amounts into our present value, we get a present value of 82,505 basically. So to do the present value calculation, see, we don't need to compare this to the fair value to figure out if it's more than 90%, because that's an ASPE criteria, not IFRS. So amortization table starts July 1st. On July 1st, we have a balance. This balance is your present value amount of your liability. And we're going to do the same thing as we did in our last question. July 1st, we also have a lease payment. That's going to bring down our liability to 63,500. Then the next year, we also have a lease payment, but we can start doing this interest. So your interest, you're going to take your I, whatever your interest was in your present value, multiply it by the balance in the lease obligation, with the 63,505 times the 9% gives you 5715. 19,000 minus 5,700 gives you 13,000. 63,000 minus 13,000 gives you 50,000. Okay, you keep going, doing the same formula, and eventually at the end of the lease term, there's that bargain purchase you have to pay. So you're paying 5 payments of 19,000 plus the bargain purchase at the end of 3,000, which means you should have 0 left in your liability balance. All right, so just do your amortization table. Part C says to do the journal entries for 2017, 2018, and our year end is December 31st. So 2017, first thing you do, July 1st, is set up your asset and liability. So July 1st, you set up your right to use asset, lease liability, and that's going to be your present value amount. Then what else happens July 1st is you have a payment. You have to debit your lease liability, credit your cash, 19,000. Okay, so the journal entries are similar to ASPE. It's just that you're going to call it right to use asset, lease liability. At the end of the December, we have 2 journal entries, one for interest, one for depreciation. This interest entry isn't going to be as simple as just picking up this 57.15 from our amortization table, because this is from going from July 1st, 2017 to July 1st, 2018. So this 57.15 incorporates a full year, so to July 2017 to July 2018. We are doing the journal entries for the year end, which is December. So we have to figure out what the number of months are from July 1st, 2017 to December 31st, 2017, and only incorporate the portion of that. Okay, so from July to December, we have 6 months. So we're going to take our 57.15, multiply it by 6 over 12 months to only record the portion up until December 31st. Okay, so you do have to really watch out for when did the lease start versus what's the year end of the company. In question 1, the lease started on the first day of when the year starts, so that was quite easy. But for this one, we have to make sure we're only including it from the lease term when the lease starts to the end of the year. Same thing with the depreciation expense. Well, first let's just look at the total amount. So depreciation expense, when we're figuring out how to record that, we have a bargain purchase option at the end of the lease term, which means that we're probably going to purchase the asset at the end if we're going to get the asset for significantly lower than fair value. So if we purchase the asset at the end, let me go back to our chart here. So if the asset goes to the lessee, and it doesn't matter if there's a purchase option or no purchase option, but we're going to use the useful life of the asset. And it doesn't say anything about any guaranteed residual value or any residual value. Question doesn't talk about residual value at all. So we're basically just going to use the useful life or the economic life of the asset, which is 10 years. Okay, so we're going to take our 82,505 divided by 10 years as depreciation. But because we started this in July, we're only taking 6 out of 12 months of that. Okay, so we're going to take our 82,505 divided by our 10 years times 6 over 12. Because we started in July, so we wouldn't take the full year of depreciation. Next year, we'll take the full year of depreciation. Next is July 1st, 2018. We are going to, so July 1st, 2018, we have a few things to do. We're going to pay cash of $19,000. We are also going to, remember we only recorded half the interest expense up until December 31st, so we can record the other half. So from January 1st, 2018 to July 1st, 2018, we can record the other half of that 57.15. Okay, so we can do that, and then we would debit our lease liability for the balance. And then we kind of got to do the same thing, December 31st, our interest expense, our total interest expense for July 1st, 2018 to July 1st, 2019 is $45.20 basically. But this is for up until July. We only want to go until December, so we got to do the same thing we did in 2017, cut this in half and only record half of it for interest expense in 2018. And then December 31st, 2018, we can do the depreciation expense for the whole year. So that's just your 82,505 divided by 10. Okay, so really watch out for when the lease starts compared to your year end. Another thing that I did not show you an example for is if you have any exploratory costs. So if this 19,000 included, now let's go back up here. Okay, so if you're doing this lease and this 19,000 also included like $2,000 for maintenance, or maybe the total amount was, let's say, 21,000, and the 21,000 included $2,000 for maintenance, let's say, for example. Then you would have your lease liability would only go down the 19,000 because that's what you use for your PMT. Your cash would have been 21,000. And then to balance this, you're going to have in other entry to maintenance expense. Maintenance expense. And that's going to be the 2,000. Okay, so if your lease amount includes any maintenance or insurance or anything like that, you're going to take that amount out when figuring out your PMT and your present value calculation. But when you're doing your journal entry, you have to pay the total amount of cash. So you're going to split it up between the minimum lease payment and then whatever the expense is. Okay, so that's what you'd have to do there if you had some extra freight costs. So if you had, if instead of it said 19,000, it said 21,000, but the 21,000 includes 2,000 for maintenance expense. And if that was the case, then you would have like this PMT would still be 19,000 to figure your PV, but you'd have to pay cash of 21,000 every year. So this 2,000 would go into maintenance expense. All right, so that's the end of this video. Hope you found that useful. And part 2 of the video is going to go through the lessor. So going through the person that owns the asset, what are their journal entries? Okay, so we'll do that for the next video. Thank you for listening and take care.